Hello viewers, welcome back. We are now looking at cash flows and discounting. We are looking at cash flows and discount rates. Choosing cash flows and choosing the discount rates. Remember, we've said in our previous video that having a proper model is supposed to make sure we are supposed to make sure that we choose the right cash flows and the right discount rates. So the discount rates and the cash flows, they are really very important for us to make sure that we have some of those things done correctly. Now, so having understood what we are going to look at, choosing the right cash flows and a correct discount rates can also be tricky. In fact, in DCF models, that is a very common place for people to make errors. Essentially, they get the wrong cash flows and incorrect discount rates. So the question becomes, which cash flows and which discount rates are in fact correct? So if we try to bring in this little diagram that you are seeing here on our screen, we can see that we have the cash flows up here on top. And we are wondering about which discount rate to use to bring those cash flows back in time at the bottom here. So the question is, are we going to make sure that we discount these cash flows using the right values? Well, a person who studied financial management or has done some financial theory might be able to tell us that we should be using the unlevered free cash flows. Those unlevered free cash flows, those are the ones that we shorten it to be UFCF, and we shall discount those cash flows back at the weighted average cost of capital. That's what we call the WACC, the weighted average cost of capital, as you have seen in this diagram here. Now, we have these shortcuts, all the acronyms that we for these two terms that we use. We say the UFCF and the WACC, that is WACC, for weighted average cost of capital, and the UFCF is unlevered free cash flow. So we might also know that these are the correct, they are the correct pair to have so that we can have a good DCF model. So we pair up the unlevered free cash flows with the weighted average cost of capital. So we pair this one and this one. So, but memorizing this, like memorizing these formulas, as you can see, is something else. But what we want to do, we want to get to the bottom of this. We want to understand why we use the unlevered free cash flow and the WACC. So if you try to look at this formula again, or this little diagram that we have here, you are seeing that the values that we have there, we have the values that are unlevered free cash flows over the WACC. So let's take a look at this diagram right here, this one right here. one theme which come up time and time again when we are doing valuation work is it is a theme of consistency. It becomes as a song. Whenever we are doing valuation, we have to have consistency in place. If we are looking at comparable trading analysis or precedent transaction analysis, which are also two very common valuation techniques, consistency is going to come up time and time again. In other words, consistency will always be there. So for this discussion of DCF modeling, the consistency that we need is between the numerator and the denominator consistency. It is within what we are taking as our cash flows and what we are dividing as our discount rate. So again, if we try to bring in this diagram into focus, if you try to bring that diagram into focus, the numerator and denominator consistency. The numerator, as you can see, the numerator and the denominator, to refresh our mind or to refresh our memory, we have the unlevered free cash flows on top here. The unlevered free cash flows on top. And we also have the weighted average cost of capital at the bottom as our denominator, this one here. Now, let's take a look at these two items, the numerator and the denominator. The numerator is actually the cash flows. In other words, the unlevered free cash flows. The unlevered free cash flows. Those are actually cash flows that are available to all capital providers. In other words, it's the money that is available to all capital providers, including the debt providers and at the same time the equity providers. And what we have at the bottom here is we have the weighted average cost of capital, or the cost of capital of all capital providers. In other words, the work that we have is computed after taking into consideration of all the capital providers. In other words, whatever we have on the bottom and what we have at the top, there is some consistency there because they are all representing all the capital providers. So the key is this consistency of all capital providers being represented on the top in the numerator and on the bottom in the denominator. So we really have here, so what we have here is perfectly consistency between the numerator and the denominator, with both representing all capital providers, meaning all the capital providers, including those of debt and equity. Meaning we have those that brought in debt, like the financial institutions, and at the same time we have those shareholders who brought in their equity. So when we are discounting the unlevered free cash flows, we use the weighted average cost of capital. And that gives us what we call the enterprise value. It gives us what we call the enterprise value. So that's what you are seeing as we've brought this side here in the right hand side. That's what we have there. enterprise value. In other words, the value of the business. So now we understand how to pair up these cash flows with the correct discount rates in order to get the enterprise value. But if we are going to model out cash flows, one of the things that we need to contemplate is exactly how long are we going to forecast. In other words, how long are we going to forecast for in our model? So what we are going to look at in the next video, we are going to dive in and look at the how long should we forecast. So by the end of that video, we shall be able to understand how best we can forecast for our model. So let's dive in the next video and we'll talk about that. We'll see you soon.